Okay, so let's talk about something wild. What if I told you that a political deal made in some stuffy room in Washington, D.C., was the secret trigger for a massive crypto rally? It sounds totally disconnected, right? But as we're about to see, the worlds of government finance and digital assets are tangled up in ways you might not expect. It all kicked off with this number, $105,000 for a single Bitcoin. I mean, that's a price that seemingly came out of thin air, hitting a multi-month high and leaving a ton of traders just scratching their heads, trying to figure out what on earth just happened. So picture this. The date is November 10th, 2025. After weeks of the market just kind of going sideways, Bitcoin all of a sudden just explodes. It wasn't some random spike, you know? This was a signal. But a signal of what? Well, it turns out the reason wasn't some new tech breakthrough or a viral meme coin. Nope. It was a deal to reopen the US federal government after it had been shut down for a while. So the big question is, how in the world does a political handshake light a rocket under the crypto market? Let's break it all down. It all starts with what I like to call Washington's money valve. You really have to understand how the simple act of the government spending, or, not spending, can either flood or completely drain the entire financial system. It's like a giant faucet for the economy. The key term you gotta know here is the Treasury General Account, or the TGA. Look, just think of it as the government's main checking account. Super simple. When the government isn't spending, like, say, during a shutdown, this account just fills up with cash. And that cash is effectively being sucked out of the markets, out of banks, and out of the wider economy. And this lays out the two sides of that coin perfectly. So during the shutdown, right, the TGA balance gets bigger and bigger, which drains liquidity and causes risky assets like crypto and stocks to drop. But the second a deal is made to reopen the government, that valve gets twisted all the way in the other direction. The government starts spending that TGA balance down, and a flood of liquidity just pours back into the market, lifting those same assets right back up. Now, here is the crucial point. This is the part you really gotta get. Smart traders, they don't wait for that money to actually land in a bank account. No way. The market moves on the expectation of that liquidity. The very moment the news of the deal broke, the market started pricing in that coming wave of cash. And that is why Bitcoin jumped almost instantly. So this brings us to our next piece of the puzzle, the crypto liquidity reflex. This explains why digital assets, which are kind of sitting on the very edge of speculative capital, are so often the first to react to these huge macro shifts. They're like the canary in the coal mine for liquidity. This crypto reflex is a pretty well-known pattern. When there's a lot of uncertainty out there, like during that government shutdown, money just flees crypto. But the second, and I mean the second, that uncertainty clears and liquidity is expected to come back, that same capital just snaps right back in. And it almost always starts with the king, Bitcoin. And this triggers a classic chain reaction. It's like a waterfall of money. First, that new liquidity hits the market. It flows into the biggest, safest crypto asset out there, Bitcoin. Then, as Bitcoin's price goes up, traders start taking profits, and they rotate that capital into the next biggest asset, which is usually Ethereum. And from there, the money just cascades down into all the riskier altcoins. It's a really predictable flow. But here's the thing. This time, that whole reflex was faster and way more efficient than we've ever seen before. Why? Well, because the market's plumbing has gotten a serious upgrade. We now have huge institutional ETFs in the game. We have multi-chain platforms that make it super easy to move money around, and we've got powerful AI analytics that can spot these movements in real time. The whole system is just smarter. All right, so this brings us to what I think is the most fascinating part of this whole story, actually decoding the on-chain clues. We've talked about the theory, but now let's go look at the cold, hard data that proves this wasn't just some random coincidence. This quote from our source material just sets the stage perfectly. It describes this pattern where the smart money, the well-informed, often bigger wallets, they make their moves before everyone else catches on. And the beauty of the blockchain is that it's a public ledger, so we can actually see this happening. And here it is, the smoking gun. On-chain data platforms, they were basically lighting up like a Christmas tree, days before the news even broke. The data showed that known profitable smart money wallets were already repositioning their funds. You could see these huge clusters of transactions showing people were buying up Bitcoin and Ether. And there was this big spike in what they call smart inflows, where wallets with a proven track record of success started opening new positions. The money was already on the move before anyone in the mainstream knew why. The conclusion here is just inescapable. This wasn't just a reaction to a news headline. The conviction to buy, the real belief in the rally, was already building on the blockchain itself. The smartest players in the game, they saw the Washington deal coming and positioned themselves to profit from the cash injection that was about to follow. So, okay, what's the big takeaway from all this? What does it mean for us? Well, this whole event basically gives us a crystal clear look at the new trader's playbook and what it takes to find an edge in today's markets. It's all about understanding this one core concept, the macro on-chain feedback loop. It sounds a little academic, but it's really simple. A major economic or political event happens in the real world, right? That adds or removes liquidity from the system. And that, in turn, triggers a predictable, totally observable cascade of events right on the blockchain, from trading volume to that capital rotation we talked about. And that right there, that is the new edge. That's the secret sauce. It's just not enough anymore to only watch price charts or only read the political news. The real advantage, the real alpha, comes from combining the two, using those macro cues from Washington as a hint, and then confirming that idea with real-time on-chain data to see where the market is really headed next. So it leaves us with this one last fascinating question to chew on. In a world where a political decision can move billions in digital assets, and where those movements are visible on a public ledger for anyone with the tools to see, where does the biggest signal really come from? Is it Washington, or is it the blockchain? The answer, it seems, it's both. And the traders who figure out how to read them together, well, they're the ones who are going to lead the way.